Also, 30 feet wide.
That's it, yeah, that's why.
Yeah.
Yeah, I'm like, that didn't work, they're gonna try it. Yeah, what do you do?
All right, welcome everyone. Appreciate everyone coming out today. We sure appreciate the business that we have from our local producers and we're excited to be able to offer some insight to these crazy ag markets that we're looking at right now. And so we have Justin Drunke here with AgWest Commodities. Go through a little bit of the presentation with some market outlook stuff. Hope you enjoyed the food. The food was from our local grocery store, Fresh Meat. They do a great job. So if you see the fever. So again, appreciate everyone coming out. There is a big, I call prize table of marketing stuff. So if you see anything that you like on the way out, feel free to fill your pockets. That's what it's there for. And help market us a little bit or help advertise for it. With that, I'll turn it over to Justin and floor is yours.
All right, appreciate it. So, yeah, my name is Justin Tromke with AgWest at the Holdridge office. So, pretty informal. If anybody has any questions, raise your hand. They don't throw the big items at me, but make a paper and throw it up and whatnot. So, pretty informal. We're just here to kind of share what we see with the markets, grains, livestock, and things like that. So, if you guys don't know much about us, here's kind of our footprint. Main office is in Holdridge, and we've got offices basically from the mountains to the Mississippi, down into Kansas and everything in between. So we had roughly, I think we're 50 employees now, somewhere around there, 30 brokers across our 10 offices, 11 offices. So yeah, we get around, we know the area pretty well, and so hopefully we can share some good information with you. We gotta share a risk disclosure document with any one of these presentations we do. You can read that, do business with people you trust, and now I'm compliant with the NFA. So that's the police of the trading world. So yeah, starting off 2025 expectations versus reality. The USDA kind of threw us a little bit of a curveball, kind of feels like that the other day. So but we'll just have to manage through it, and the numbers are what they are, so we'll go through them here just here quickly. So we've had a couple of back-to-back for the row crop guys. We've had a couple back-to-back tough years. We've had 2024, the high came in January. You look at all the high when the months are in the middle here, and when the high is in that month for that year, December new crop corn, we put it in that category. So the high in 24 was January. We just marked the high in 25 in February, and that's not very common. Only about 3% of the time we see a high in February in December corn, and since 1970, so 56 years worth of data. So statistically speaking, we just don't have very many highs in February and not very many highs in January as well. And we had two back-to-back years of pretty early numbers. So we'll go through the data here. Take a look at the market structure, kind of big picture. The USDA numbers that were out the other day. 8 million acres is where they came out with the planted numbers. 91.3, so it was up like 66,000 acres. They round that up to a point. One is 100,000 acres on this. And harvested acres were up 1.2 million to 91.3. So I think a lot of people right in this room was, how in the heck can they find that many more acres out there? So we looked at the FSA data out there, and there's always a spread between the USDA numbers and the FSA numbers. The FSA number is always going to be lower than what the USDA says. So why? Well, not everybody participates in the farm program. So they just don't have to report their acres to the FSA. Therefore, FSA is always going to be lower than what NASS says. But you look at that ratio there, and we're 98.5%, 98.65 is what that USDA versus NASS or versus FSA numbers are. So when you look at that, it's fairly consistent, and we're right in line with history, at least the last 4 years. So like it or not, I guess we gotta kind of agree with that, in some respects, so. Here's what the USDA thinks the corn yield is this year, and, I personally really don't, I have a tough time agreeing with that. Because of this, when you look at the disease pressure we saw, I traveled a lot through Iowa, eastern Nebraska, and everything looked really good right up until harvest. And late August, early September across Iowa, driving across Iowa, it looked like November there. A lot of corn was just flat dead. So, a lot of this was disease pressure. A lot of our customers across Iowa were saying we had anywhere between, 10 bushel, to 80 bushel differences on corn if we sprayed fungicide or we didn't. So when you look at that, the USDA number, for Iowa is half a bushel less than a year ago. And we're just hearing pretty consistent yield numbers of at least 15 to 20 bushel below a year ago. So I just have a hard time really accepting the Iowa number especially. Now, USDA said the other day, Wayne Sony came out, he said those fringe acres, the western Nebraska, North Dakota, South Dakota, Minnesota, they did have tremendous yields up there. The high plains had better yields. And basically the culmination of all those better numbers offset Iowa, Illinois, and Missouri, some of those problems with the disease pressure there. So that's what they're saying. I still have a hard time believing it. So, but like I said, whether you believe it or not, that's the USDA numbers that we're gonna have to deal with. When you look at the supply, you bring in the 1.5, everything on the left-hand side is the 24 crop. So, the marketing year goes from, September 1 to August 31, and we're at a 1.5 carryover last year. You carry that into this year, and we're 1.5 here. You take the acres times the yield, and you get a 1.7 crop, and, with a few imports sprinkled in there. We got a 18.5 million bushel crop to chew through in the next 12 months. That's a big supply out there. So when you look at that on the chart, biggest number we've seen in really for modern history, right? Since I think you go back to the 30s and 40s, we've had more supply than that. But it's pretty good chunk of corn out there. The good thing is, we have a ton of demand. We have good demand, compared to last year, good demand compared to history. You look at the feed residual, they have that to 6.2 billion. I put a question mark there because quite frankly, I do have a question mark for that. I was skeptical of the 6.1 billion, where they raised that 100 million. I'm really skeptical of it, just because last year we used 5.4 billion in feed residual. And that's a little bit, and I'll take that for what it's worth. In 23, we used 5.8 billion bushels in that feed residual category. So, 2 years ago we were up, last year we were down. We fed a lot more wheat last year, so I think that's the reason for that. But we're feeding cattle bigger, so we are using more feed, I believe, even though the numbers are down. So I can argue that we're probably bigger than 5.4. I have a hard time with the 6.2, but we'll kind of get in that here in a little bit. Ethanol at 5.6, that was unchanged. And we've got really good ethanol demand. If you look at what we need to grind every week, we're hitting that goal to hit that USDA number. So I believe with all the E15 talk, actually, I think this number can probably grow. There's a limit to what that can grow, but I think we can maybe put another 50 million, maybe 100 million bushels on the ethanol demand here this year. So that would be extremely good, just more demand out there for corn. When you look at the exports, 3.2 billion bushel on the export number, those are pretty solid numbers. I don't disagree with that whatsoever. So when you stitch it all together, we've got 1.2 billion more bushels expected to be used in the next 12 months than we had a year ago. So this is a very positive thing for the row crop guys out there. Now, we're still not using as much as we grew, so we're still building inventories by a little bit, but definite positives out there. So that brings carryouts down to 2.2 billion. That's 198 million higher than last month. We look at that more of a stocks to use ratio. You take what our ending stocks are, you divide it by what we use it, you come up with a percentage. That percent is 13.6%. And you look back from, the drought in 12, we got down to 7.4 stocks to use. That created $8 corn, right? When we get up into that 13, 15, almost 16% stocks to use, what were prices back then? We had a range of anywhere between 320 and about 450. So that's kind of the range we had from 2013 to 2020. A pullback after COVID, prices went up to 7.5 again. We started ratcheting up, and now we're kind of back in that 13% stocks to use. So we're comfortable. We're not overly burdensome when you look at this. I think these numbers tell a better story than just the flat number, because we're using more corn than we did 5 years ago, 10 years ago, 20 years ago. So it kind of smooths that out a little bit. This is probably the most bullish slide that you're gonna see from me all day, for the row crop guys. When you look at the world stocks to use ratio, that same thing, take your stocks, you divide it by what our usage is, you get a percent. And worldwide, we're down to 19.3% stocks to use. Again, we're not overly burdensome like we've been the last 10 years, but we're not overly tight like we were back in 2011, 2012. Does that become an issue, and does that become a story that maybe the hedge funds grab onto, the algorithm traders grab onto the headline or whatever, and get this excited? Probably takes a weather problem for that to become a headline, but a lot of this is because China's stocks are dwindling. They made a pretty big effort to ramp up stocks pretty high in the 2015-16 crop, 16-17, I think that was. They ramped up stocks. They've been dwindling those back here. Again, they're lower, but they're fairly comfortable compared to historical values. Are they going more towards, not having to have as many stocks on hand, maybe spoilage is an issue, things like that. So if there's a storyline that China needs corn, will they come to the US? Will they come to Brazil? That's the $1 million question. But nothing yet. But if this can turn into a storyline, that would be positive. When you take everybody else except China, take Chinese data out of it, it looks a little different, but we're fairly flat. That increases just from the US, but we are fairly flat, which again, I think it's not really super bullish, but I think that's a good thing. It just tells us that we're using as much, if not more corn than we're raising worldwide, even though the US had a big crop this year. So any sort of weather hiccup, any sort of production problems we have, that can get a spark going here this next year, 26. So that'd be our opinion. On the soybean side of things, 100,000 acres more on soybeans as well. So slight increase, don't have any disagreements with the USDA. You look at the FSA, USDA spread, that's usually 99%. Pretty common for that going back the last 4 years, so no disagreements with the USDA on that. Yields were pretty mirrored of the corn crop, and western states did well, eastern states not so much. Nebraska, 65 bushel yield. I farmed as well. I had the best soybeans I've ever raised. How about you guys? Have you guys done pretty well on soybeans this year? Good. Yeah, average. Average. Okay. So, yeah, we'll see what that how that plays out. On the supply side of things, pretty adequate supplies. It's not overly burdensome. We're 4.6 billion bushel. That's up 17 million on this report. When you look at that on a chart, fairly flat, and that's a good thing. We don't want to be building inventories to burdensome levels. We are at the high side of the range, but we're level there, so that's good. We're using beans. And stocks aren't really building here in the US. When you look at the demand side of things, really good crushings, though went up 15 million, exports not so much. So when you look at the crushing numbers, they're just on the trajectory to keep going higher. I think these numbers are gonna flatten out here in the next couple of years. The reason being, when you look at all the plants, the renewable diesel, just the crush plants we have out there, the blue ones have been built pre-2023, so they've been in production for a long time. The orange ones or the yellow ones, 2023 to 2024 start. Some of these plants have gotten built for renewable diesel and sustainable aviation fuel, they're coming online. So 2025, we built out another, I think it was 80 to 90 million bushel crush capacity is what got added. And in 2026, with these new plants coming online, this one's an addition to what's already there. New one in Ohio, an addition in one in Illinois, and I think this one is David City, which is actually Runman, but one in South Dakota. We're gonna bring on another roughly 110 million bushel of bean demand capacity with these crush plants. But then after that, it levels off. We don't really have anything in the works into 27 to 2030, and I think that needs to change. But why are they're not new plants coming online after that? It's because it got really expensive to build these plants. Interest rates went up and the cost to build these things or upgrade them into a renewable diesel sustainable aviation fuel plant got just prohibitively expensive. So we need policy, we need better policy to incentivize these plants to come online, because with exports, we are dwindling our exports year after year. Now, there's the deal with China that got signed, and we'll talk about that here in a little bit. But Brazil is just basically kicking our ass on exports. They're a lower cost provider, and we're just gonna keep losing ground to them on our exports. So we gotta find that domestic demand, because exports, in our opinion, are just gonna keep going lower with soybeans. When you look at that as a stocks to use ratio on soybeans, we're 8.4%. So we're, again, comfortable, we're not overly tight. When you start getting below that 6% on stocks to use ratio on soybeans, the market gets pretty concerned about where we're at. Anything 8% to 10% and higher, we're not in a big crunch with soybeans for the moment. So kind of middle of the road right there. When you look at world ending stocks, this is all Brazil. They just keep raising their production, and therefore their stocks keep going higher. Brazil is a big country. Mato Grosso is the main area where they grow a lot of soybeans. So you can see what kind of area landmass that is. We can fit Iowa, Illinois, Indiana, Missouri. You can take Nebraska and sprinkle it in the margins here, and that would all fit. So it's a big state inside of an awful big country, and they're adding anywhere between, I think, 1.5 million acres this year is what they added soybean production, to as much as 3 to 5 million acres when prices are, you know, in the teens on beans. So they keep adding acres. Last I've seen, about 40 million more acres is what they can bring into production without cutting down a single tree. They're adding what's called the Cerrado. It's a lot of grasslands and pasture. They call it degraded pasture. I don't know what degraded pasture looks like, but that's what they call it. So they're not tearing down trees. The Amazon rainforest is up here in the northwest part of this state up there. So yeah, just a big country, and they're just a monster out there. Now, when you look at it worldwide, again, stocks to use ratio, we are fairly flat. So that just kind of tells us that even though Brazil's stocks are growing, the rest of the world is using more beans. And, you know, we're plenty high, don't get me wrong, we don't have a problem there, but I do like the look of that just flattening out here. It just tells me that demand is strong for beans worldwide. So 2026, we kind of come up with just kind of a theme every year. Pretty much a deck full of wild cards in 26. So we'll go through some of those that we see out there. One, obviously, is China and the trade issues that we have with them. And let's not kid ourselves, a lot of these issues revolve around the rare earth minerals and the fact that China controls 90% of the processing and 60 to 70% of the mining. It's a very dirty process to mine these. So the rest of the world has kind of taken over that, but we need these for chip making, right? All these rare earths go into these chips. Those chips go into a whole host of things, but the main thing is they go into our advanced fighters. Now it's a national security issue. So China definitely does have leverage over us on this. So we're trying to find leverage on them with our markets, and soybeans have kind of been the casualty of that battle there. So they did promise to do 12 million metric ton of soybean imports from us by the end of February. And latest guess is they've done that. So I don't think we've seen officially those numbers be reported, but sources inside say that we have officially hit that 12 million metric ton mark. Now, they promised 25 million metric ton per year the next 3 years. Will that actually happen? Well, I'm not a big believer that China follows through with what they say all the time. In fact, I don't think they follow through with what they say anytime, if you look back in history. But I guess the one thing we got going for us is we should have the same president in the next 3 years to help enforce this. And, he's not afraid to use more tariffs as a bargaining tool, to make this happen. So hopefully that demand from them does pick up. That'll bridge that gap between domestic demand and export demand that we're losing. So in my mind, we got 3 years to figure out policy to incentivize more domestic demand on soybeans, is what this has given us. US Supreme Court ruling, are tariffs legal? Are they not legal? I think China's probably waiting for us to shoot ourselves in the foot on this issue. We'll see. I haven't seen anything lately on that. And then tensions over Taiwan, that's kind of popped up here. They don't want us messing around in their backyard. Obviously, with this Greenland and Venezuela deal, we don't want China and Russia messing around in our backyard. So, we don't need that to escalate. That would be bad for commodities, getting into a war with China or anybody like that. We just don't want to see that. So you look at Mexico and Canada, the USMCA agreement is set to be reviewed and updated in 2026. We won the battle with Mexico on the GMO corn. They wanted to ban imports of GMO corn from the US. The courts upheld that ruling, so that's good. We definitely don't want to lose Mexico as a customer. They are our biggest customer. We've got a rail line that goes directly to them, and their imports of corn have been just awesome this year. We want that to stay in place. That's why we have 3.2 billion bushels of expected export demand on corn. So definitely don't want to lose them as a customer. When you look at Canada, they're our biggest export market for ethanol. That's kind of the red shaded box there. And then you've got, I believe, UK is the next. This would be other countries. This would be the EU, and this would be Colombia. You can see Brazil, when they put their 18% tariff on US ethanol, what did that do to our ethanol exports to Brazil? They went to basically nothing. So definitely want to keep Canada happy. We like their crude oil, they like our ethanol. But what scares me a little bit is they're starting to make deals with other countries for some of these other goods and services and steel, aluminum, and crude and things like that. We just tend to lose a little bit of leverage every deal that's done there. So, but so far so good with Canada. Fertilizer's been a big wild card, going into fall. The tariffs were a big deal with the suppliers. Everybody was running scared. They didn't want to fill up any tanks and buy product because they didn't know when those tariffs were going to be applied. They apply when the boat hits the ground here in the US, not when they buy the fertilizer. So that's a month or two down the road when they buy it. And they just weren't sure how that was all going to play out. So the suppliers have been really hesitant to make any big purchases. They don't want to take that risk out there. And now, with the high prices, farmers don't want to take that risk and buy a bunch of high price fertilizer in fears that it goes down in the spring and they can buy it cheaper down the road. So it's kind of a chicken and the egg deal right now. We got to get product placed, has to be available for you, but everybody's just kind of running a little bit scared. We are coming out of 2025 with some pretty low inventories. I've seen a chart the other day. I believe we're 77 or 78% of our normal fill for this time of year on nitrogen. And there was a couple plant closures around the world last year. There was a couple plant fires, some shutdowns and things like that. And then we planted 98 million acres of a crop that needs a lot of fertilizer, right? So we depleted that and we were short going into 25 crop. And now we're short going into 26. Will we run out? I doubt it. The retailers will tell you, if you don't buy now, you may not get it. I've heard that before, right? So it always seems to be there, but we definitely are low on inventories. What's that tell us? Probably don't hope for a whole lot of improvement here going into the spring. UAN has been pretty steady. Phos has come down a bit. Potash, we don't use a lot of potash around here, but it's been pretty steady as well. So our opinion, I guess, is that UAN prices probably won't be any cheaper in the spring, if maybe a little bit, but that's about it. These tariffs being dropped on November 14th, that definitely helped that out, mainly the phosphorus numbers coming out. Another wild card, world economy. How does the economy shape up? Are we going into recession? Is there a fear of recession? So we look at this as kind of a big picture type of a risk out there. The stock market has been on fire this year. The S&P's up. If you own gold, I see gold hit a new high the other day or today. But the real economy has just been kind of struggling here to really keep up with what the stock market's doing. So stock market's not a real good gauge of what the economy is, the real economy. Housing affordability, $400,000+ average home prices now. I don't see how a new family trying to build a family is buying that kind of house and paying those kind of prices. They just aren't, they can't. So is that going to affect anything down the road? The non-housing debt, when you look at student loan debt, that gap is widening. We're at 1.65 trillion in student debt. When you look at the credit card debt, that gap is really widening pretty good here, and that might be a concern here going forward about a potential recession. The delinquencies, it's kind of funny here, the student loans are the red, and remember they forgave after COVID, you didn't have to pay back your student loans, or they kicked the can down the road, basically. You have to pay it back right now. Now the government wants their money back, delinquencies are starting to go up again. So you got credit card debt, that's the big one that I'm concerned about. We're back to levels we've seen in 2010 or close to it, but those delinquencies on credit cards are starting to rise, and that might be a concern for the real economy. And if attitudes change and we slip into a bit of a downturn here. Rest of the world, what's the rest of the world doing? Well, I've been talking about this for a couple of years. China has hit a population peak in 2023, I believe it was, and they're set to lose about 500 million people in the next 50 years. Good news is India is set to gain about 500 million people in the next 50 years. It's the whole one-child policy that's kind of coming back to bite China in the butt right now. So what we worry about is if that population is aging and there's not as many young people to come up and come out of the farms and into the cities and get higher protein diet, more make more money, eat better. Do they need more protein? Do they need more food stuff? What do their exports look like in 5 years? This is not a 2026 play. This is a 2030 and beyond play. So is that demand from China going to stay as strong as it has been is the worry here. So we hope that we can build some business with India, but they're incredibly protective of their farmers. You all pay what UAN is 400+ a ton. And how much India pays for urea? At about $50 a ton. Their government subsidizes that much on their fertilizer prices. So they're really protected. They don't want to see their farmers have any Western influence come in and take their markets away from them. Debt problems. China has debt problems. Their stimulus hasn't really been working all that well here as of late, but everybody has debt problems. The US has 125% debt to GDP ratio right now. Canada's at 114, Brazil's at 91, China's at 96, Japan's at 230%. So that'll be interesting to see how Japan, gets through this, so. But is this sustainable? That's the million dollar question here. I don't know that it really is. It took us, what, 200 years to get to $1 trillion worth of debt. And now we're adding $1 trillion of debt every 5 months in this country. It just doesn't feel like that's real sustainable here going forward. Now, we can GDP our way out of it, and I think that's what they're trying to do right now. These are all projections based on a, I believe it's a 1.8 to 2% GDP growth. We're growing at, I think it was 3.8 or 4% the other day. So we can grow out of it, but we're still adding that debt. So is that sustainable? Again, will Japan be the canary in the coal mine? Their bond rates have really taken off, and they're gonna pay an extra $27 billion every year for an interest with their bond rates. They spiked the other day, the minister of Japan, the finance minister came out and said, you know, we don't panic, things like that. Those kind of things get people pretty nervous about investing in countries and their health of their economy. We need other governments to buy our bonds, to fuel our debt. And if that dries up, that's a big problem. So, wild card number 4, weather. That's always a wild card every year. Brazil and Argentina are gonna be the main focus here on weather. They're done planting soybeans as of middle of December, pretty much in Brazil. What they planted here about the 10th of October to the 1st of November, that's what they're gonna start harvesting. So you're gonna see harvest percentage in Brazil really start to ramp up on soybeans here pretty quick. Why is that important? The quicker they get soybeans harvested, the quicker they get corn planted, and it falls into a better time of the year where they can have a better crop. If they get planting too late on the corn, they do have a dry season, believe it or not, and it'll push pollination on that second crop of corn out into that hotter time of the year. And so there'll be a time where they just stop planting because they're worried about it making it and finishing before the dry season sets in. So really, we kind of hope that South America, Brazil particularly, gets pretty wet and they can't get the beans harvested. So far, the last month, they've been pretty good compared to normal. The 1 month precip is a little drier, but when you get 100 inches of rain during the growing season, a little drier than normal is okay. So they're still expecting a record crop down there. You can see where the main soybean areas are in that Mato Grosso. This is where they're adding those soybeans to the mix out in that Goiás and Bahia, Minas Gerais, and I'm sure I'm butchering those names, but so that's where they're growing, but no real weather concerns in Brazil right now. And really the same thing in Argentina. They are getting close to being done with planting corn and soybeans. It's a long planting season for them. There is a little bit of worry here. The 11 to 15 day forecast is some pretty hot, dry areas. You can see where their corn and soybeans are grown right in the center region here. It's kind of reference that bay right there. Buenos Aires is right on this bay here. So if you're looking at a map, it's been kind of dry in the southern area there. And that forecast is kind of a big donut right here for that area to be dry for the next couple of weeks. They're getting into some pretty critical times for some crop development, and that might be an issue that we get a little bit of a excitement about the crops on board trade. Weather here in the US, the drought monitor really this time of year doesn't show, and there's no correlation between the drought monitor on January 21st and a drought next summer, right? But this is a drought monitor. We are drier in the southeast than we were a year ago. And if that sneaks up into the Ohio River Valley this summer, that might be a problem, but too early to tell. Just kind of wanted to show you that compared to where we were a year ago on the drought monitor here in the US. Ethanol, E15, renewable diesel, SAF, kind of go through that. That's going to be a wild card here going forward. The API did come out today, and they are finally, I think, API, American Petroleum Institute, and the ethanol providers out there, they are as closely aligned with E15 being sold year round across the country as they ever have. So they're finally unified in pressuring lawmakers to allow this E15 to be sold year round. It's been able to be sold year round in, I think, 8 Midwestern states. And that alone has increased our blend rate. We're officially blending 11% of ethanol into the gasoline supply right now. So that has helped, but E15 would slowly raise that and create more domestic demand. So that would be a good thing that we're definitely wanting to see. Will this finally be a reality? Well, with Biden, all these lawmakers and lobbyists have kind of had to change their tune. With Biden, it was about being green and sustainable and saving the earth and all this stuff. With Trump, it's just about kicking ass and taking names. We want to be dominant about fuel supply, we want to be the #1 fuel supplier in the world. So they kind of had to change their tune to get this administration on board. So from what I've been hearing, there's good things out there. So hopefully there's a chance that this is gonna be a thing. We've only been talking about it for, what, 10 or 15 years about this E15. Now it's gonna take a while. You gotta have the gas pumps certified for E15. You wouldn't think E10, E15 would be that different, but the seal on the hose has to be E15 compliant. If it's not, you can't run E15 through it. The tank has to be certified. The hose itself has to be certified, the pump has to be certified. So now you're into weights and measures, people, someone on a power trip that says, I can stop this thing, maybe there's something like that, I don't know, but, so it'll slowly happen, but this definitely will be a good thing if it does. California has adopted this back in October, they see a value in it, so that's good, but we're not the only ones. Brazil is adding another 15 ethanol plants or adding on to plants right now. This is a world deal. World ethanol is a big deal to try and be low carbon, and whether you guys agree with the whole low carbon, anything, and whether that's saving the world, Paris Accord, all that stuff, your opinions are your opinions, mine are mine, and we'll leave it at that. But the rest of the world is ramping up ethanol. Brazil is mainly because they're adding more acres of soybeans. They're adding more acres of corn, and they gotta get rid of corn. So they went to an E30 blend in their fuel supply, and we're squabbling over E15. I think we're behind the 8 ball on this, so, we'll see how that all plays out. 45Z and 45Q, just kind of want to go through those tax credits, what we know about them today. The 45Q is the carbon sequestration tax credit that an ethanol plant has to compress CO2, put it in a pipeline, ship it somewhere, put it in the ground for long-term storage, right? That's the tax credit, 45Q. There's only one pipeline that is in operation right now, and that's the tall gas pipeline. So I believe Chief Lex is this one here. Madrid is hooked up to it. Kappa in Minden, all Kappa plants are hooked up to it. So there's 10 of them so far that are hooked up to this. That they put in a pumping station, a compressor station. They inject it, as a liquid. You gotta compress it to, it's pretty high pressure to get it into a liquid form to pump it. So this pipeline has already been in service. It was providing natural gas. Now it's pumping CO2 back to the west. So this thing is in operation. The sequestration of this carbon will reduce the CI score of an ethanol plant by about half. Maybe a little bit off there, but it's roughly half. Why is that important? Again, the world wants cleaner fuel. California wants a low CI score. They want to know where it came from. You might start getting asked from your elevator to provide a shape file. That's because California requests that now. If you don't provide a shape file of where it came from, they just want to know how far you had to haul that corn from your field to the plant, so they can attach a score of how much diesel fuel you burnt to get that corn into the ethanol plant, basically. So California is requesting that, or requiring that to sell ethanol into California now. So it is a big deal to them, and these plants want to lower their carbon intensity score. And this is a way to do it. they're getting $85 a ton tax credit. And I think a 100 million gallon plant will produce, I can't remember the number exact, 200,000 tons of CO2. And so that's about $25 million a year in tax credits they'll get. So you can better believe that they're wanting to get hooked up to this pipeline if they have access to it. The Summit Pipeline is one that's been proposed in Iowa. It's been proposed 4 years ago, maybe 5. To hook up all these plants. I can probably take this branch because these plants down there here have hooked up to the tall grass. But this one, I don't know if it's ever gonna happen. When I talk about this in Iowa, I kind of got to cringe because it's some pretty tense conversations about safety and what happens if this pipe ruptures. It's under huge amounts of pressure, and CO2 is heavier than air, so it's gonna sink to the ground. And it's the deoxygenator, so, basically you run out of air and you suffocate. So that's a big problem when you're sitting on the pipeline. Regulatory issues, eminent domain issues, so I don't know if this thing is ever gonna get built. And why I point this out is because with this tallgrass pipeline, I think that gives Nebraska a running start for all this. We're gonna be at least 3 years ahead of Iowa or anybody else that puts a pipeline in. So if you're an ethanol plant that sees, or an ethanol company that wants to build a new plant because of E15 year-round sales, maybe that turns into an E15 mandate, where are you gonna build a plant? Where you can get a $25 million tax credit a year, or where you can't? I'm gonna be an investor in Nebraska ethanol, so that's good for Nebraska corn producers here in the future. Now, I don't see any new plants getting built right now, but I think that could be a good thing here going forward. 45Z is a credit for the producer of clean fuel, which is an ethanol plant, a bean crush facility. They lower the CI feedstock, or lower the CI score of that plant by bringing in low carbon intensity feedstock. And this is what everybody's been, the buzz has been about the last couple of years. Corn is 40% of that plant's carbon intensity score. There's no guidance on this yet, 100%, but it's cover crops, it's minimum tillage, and it's reducing your nitrogen. So split applying, whatever it is, you get a score as a farmer. You gotta track that. You gotta have someone verify that. You sell your corn to the plant that's verified where it comes from, all this stuff. The plant gets their tax credit and they share that tax credit with you. It's a wonky system. It's kind of weird how it all has to transpire if it does. But hopefully that will put some cash into your guys' pocket if you choose to follow those regulations that aren't out yet. So they've been talking about these regulations for a while, and we just don't have that guidance quite yet. So when we do, that should be a good thing. We'll just have more clarity. Problem is, what I'm told, and this is the law, the way it's written today, an ethanol plant cannot take both the 45Q and the 45Z together in the same calendar year. You do one or the other. So that kind of cuts out anybody that's hooked up to a plant. They're not gonna be able to offer the 45Z tax credits to anybody. Now, that's the way it's written today, from what I understand. That may change. There's probably a loophole out there that they can do that, but that's kind of the way it's written today. So let's talk about livestock here. This is a little better picture. We've got the lowest cattle inventories we've had since the 60s. We were feeding cattle up to 1,000 pounds back then. We're feeding them up to 1,700, 1,800 pounds now. So we're just making up numbers with pounds. The thing we worry about out there is, where's the breaking point? Where does the consumer say enough is enough? And so far, we haven't seen that. Hamburger is over $6 a pound just for hamburger. I was in a conference in Kansas City a week ago. Went out to eat with some people there. Had a 14-ounce Kansas City strip. Good piece of meat. I've cooked better at home on my own grill. Just for the chunk of meat was $78. And then you had to buy sides and everything. It's $100. to go eat a steak in Kansas City, a nice restaurant, you not all over that way. But, so what's the breaking point? Is it that? Are we there? Are we not? So take a look at some other stuff. High cattle on V numbers, that should be friendly cattle market for quite a while. That's not gonna change anytime soon. The Mexico border is still closed. That doesn't seem to be changing anytime soon. That should be friendly for the cattle market. Demand has turned pretty inelastic to some point. High protein diets, people just wanting to lose weight, just better health of high protein diet is out there. I don't really see that changing much at all, and that should be bullish for cattle as well. Now, heifer retention is happening. It's not in a real big way yet. Some of you ranchers in here may have a better idea of that than I do. But we are starting to see some, which actually lowers the supply in the near term. But then that supply comes back in a year or two from now. So, they're bullish now, maybe bearish down the road. Will that play out that way or not? Those economic concerns we talked about, they're definitely in the background. Nothing is that worrisome quite yet, but definitely something to be concerned about. Beef is probably the most sensitive commodity out there to economic concerns. If we go into a recession, beef is usually one of the first ones, just because of that. It's a premium product, and what do people do? They cut out their most expensive things first. So we looked at this. The last time we had a high in the cattle market was 2014. That rally from 08 to there was 284 weeks. It was an $89 rally. Topped out in November and was 56% higher than the previous high. So everybody talks about, does history repeat itself? Well, no, not exactly, but it kind of rhymes. So we look at this rally so far from the low of 2020. We rallied 288 weeks. Pretty darn close, $171, almost double, 45% higher than the previous high. You can see it kind of rhymes. So are we at a high yet? Kind of felt like that here for the past month, that this pullback was what, 50, 60 bucks, 100 right there. We've brought back 60% of that now. So will we take out this high and just keep marching higher, or will we fall short of that and start downtrend going forward? Well, I wish I knew. If I did know, I wouldn't be sitting here talking to you guys. I guarantee you that. I'd be trading my own futures account, sitting in somewhere a little warmer and more tropical, let's just say. So we've talked about this in our alerts for the last 2 years at least. There's a 10-year cycle in the cattle markets, and the lows typically come in a year with a 6 at the end of it. So the high in 79, so week 6 with a 37% drop. The lowest one we've had was 26% with that low there, and that took 3 years, so that's kind of important here. Now, COVID did screw it up. We put another low in 2020, and that might screw up this whole 10-year cycle deal. It kind of feels like if this high is the high, and we do go down, percentage-wise, if we had a 26% decline, that'd put us at 183. If we had a 47% decline, that was the biggest one, that put us at 131. So that's where those arrows are there, just to kind of show you a frame of reference. We've had an 18% pullback so far, so is that the start of something? I don't know. The 3-year deal, this one was the shortest time frame. Kind of feels like that high, if it is a high in 25, that probably pushes a low potentially out to 27, maybe 28, just time-wise. It doesn't really make sense for what we've seen in history that it would be a 2026 low. So I hope I'm wrong. I hope we are gonna have another leg higher, and this whole thing is blown up. We can stop talking about it. So, but definitely something to worry about. All we're telling people is, if you're in the cattle business, there is a whole lot of risk here, right? Do you have more risk to the upside from 250, 260, or do you have more risk to the downside? In our opinion, there's way more risk to the downside, and guys just need to be hedging at this point. What do we do for hedging? Well, LRP It's a fantastic, we're not an insurance agent, so, we don't sell LRP, but we sure like it. It gives you guys a fantastic floor out there. You can hedge exactly the number of cattle you have, where options are 40,000 pound contracts on, live cattle, and 50,000 pound contracts on feeders. Just makes the number thing a little bit easier. Heavily subsidized, you get a pretty good price floor for a pretty decent cost for that. The cons, you just don't have the flexibility like an auction does on the Chicago Board of Trade. So we'll go through an example. Pulled this up this morning. This was as of yesterday, 8-week steer. April is the expiration month, April 21st. 356 is where your floor would be. It's gonna cost you $15.40 a hundredweight. The government's subsidizing it down to $10. So they're subsidizing it pretty heavily. Kind of looks like that on a chart today. There's an April fat cattle chart, and there is where your floor would be. Perfect. Go do that. Edge it up. Get a floor in place. If this thing is close to a top and it goes down, you're gonna be darn glad that you did that. Okay? Feeder cattle works the same way. What we're saying, with the kind of volatility that we've had in the cattle market, we can still use options. Don't forget about the options. If we can get that moved up, if the market does go higher, this isn't actually a chart, I doctored the chart to just prove a point here, right? So if we do go higher, we would buy a 376, 356 put spread. We'd spend about $6 to get that done. We don't want to spend too much. You got a put spread. Now you raised your floor up $20 for another $6 cost. You are protected down to where your LRP is, and we feel pretty good about that. If it keeps going higher, we will roll that put up, that long put, and roll that up to a 396. And you still have the short 356 put, so now your spread looks like that. You're not protected with the option here, but you're protected with the LRP down there. So it's a way that you can still participate in an up move in the market by layering in some options on top of your LRP there. So just a thought. Doesn't work in a flat market. If this market just kind of goes sideways, you're just not gonna have the opportunity to really do that very well. But these big volatile moves that we're seeing give us the opportunity to do that. All right, so 2026, if you didn't see the opening slide, our theme this year is how do we survive, especially row crop guys, how do we survive this tight margin environment? That's where we're at, right? We had a big crop, prices are lower, inputs are higher, and it's a pretty good squeeze. So how do we survive this? So you type in Survivor and how to survive stuff, and Survivor pops up. I didn't realize Survivor was even on the air. Season 50, so that means they've been around 25 years. It makes me feel old. Because I used to watch it back then, I don't anymore, and I realized why after looking at this picture. I mean, you got a beautiful beach in the background, and that sakes, this guy's wearing a sweater, right? So when I was watching it, here's what the cast looked like back then. So a little friendlier to the younger generation on watching it. So what do we do? I think we gotta start with a plan. And if you've been to any one of our presentations in the last 25 years, we've probably said this. Everybody needs to have a plan. If it's on the back of your handout we gave you, it's on the back of a napkin, if you've got a fancy Excel spreadsheet, you just need to have a plan out there going forward. Now, I'm sitting with a room full of bankers, and this is no dig to you guys, but you guys need to tell your banker what your break even is, not the other way around. What I mean by that, you gotta dig into your numbers. You gotta know exactly what your numbers are. You know, the deadbeat brother-in-law that you had to buy a new car because you can't afford it. Well, it comes from somewhere, right? The farm account paid for that. Farm account paid for a lot of stuff that maybe isn't farm expenses. You gotta have those in there. You know, family living is kind of out of control from my banker, what he tells me. But go through your numbers with a fine tooth comb. This is our cost of production that we use a lot. Just has all your variable expenses here. puts in a nice pie chart and a nice cost per bushel, production. We have this available in Excel form. If anybody wants this, talk to me afterwards and I can get you a copy of this. It looks different than this, but it works the same. And then you just gotta define your risk. Dr. David Cole says that there's, out of a 10-year stretch, you're gonna make good money every 2 years. And the other 8, you're just gonna struggle. You're gonna struggle to be profitable. You make a little bit, you may lose a little bit. So you gotta really take advantage of those couple of years and fight in those years that you aren't very profitable. You gotta define what your price risk is, your production risk, that's why you have insurance, and your emotional risk. All these things matter, and you gotta have a plan for all those. So we'll go through some ideas of what we could see this next year. There's no guarantees on this, of course, but I plugged in the 98 million acres, the 186 yield. Now we talked about that feed residual category where I don't think there was 6.2. I plugged in a 5.9 billion bushel feed residual. I got ethanol the same, exports the same. So I'm more at a 2.5 carryover. That's what I'm gonna use for this example, just so you're aware. What are we gonna plant for acres next year? If we have 96 million acres and the USDA comes in, trend line 182, maybe 183 is where they'll come in on their May numbers, just using a trend line. I keep demand, now this is all demand a year from now, so this is a long ways out, and these numbers can change. But if I just assume that we're gonna have as good, I did lower exports to 3 billion in this scenario. But if we have good demand like we had, and a 182 and 96 million acres, we still have about 2.6 billion bushel carryover, 16% stocks to use ratio. Remember I said anything below 10, the market gets excited. That's not gonna get the market excited. What does get the market excited is if we have a weather problem, or this is a hiccup, this isn't a drought. 170, it was a record 10 years ago. So at a 170 yield, we've got the demand base built right now, that gets us down to that 10% stocks to use ratio, and that might get the market pretty excited, okay? Just read today that, I remember who it was, came out, their projections were 95 million acres. I've got 94, and at a trend line yield at 182, we're sitting about where we're at today at 2.2 billion. 14% stocks to use ratio, again, that's not bullish. A weather hiccup along the way, and we're at 1, 2, and 8%, so that's gonna get fairly pretty quick. So what do we see risk as? This is a continuous December chart, a high of 22, a high of 12, and that 13 to 20 range that we saw, corn trading between 320 and 450. We hope that this is a new ratchet up of this risk. Now this 385, last year's low was 391. We hope that that's kind of a new risk floor. So that's kind of what we're gonna say 2026 risk could be if we plant 96 million acres and have another 182 to 185, 186 crop. So, realistically, I think we better have a plan for that. What are we gonna do about it? Our official recommendation right now is we're trying to layer in some 470 puts for around 25 cents. It's gonna take 485 to get that to trigger. And after the report the other day, we're seriously considering changing this recommendation a little bit. So, but that's where we sit today. We're gonna layer in some put options. They just give you a 4. Soybeans, we think this 950 is a pretty good support level. This 1080 means something. And, so what we're gonna do about that, we're gonna try and buy 1140 puts for 40 cents to give a guy an $11 net floor, minus basics, of course. It's gonna take 1170 roughly to get that filled. So it's not anything that's gonna get done today, but have a plan for it. So then you gotta spot the opportunity out there, and opportunities, they just don't look like what they used to 2 years ago, 3 years ago, 4 years ago, when we had really good priced corn. I was trying to figure out a way to illustrate that, and I finally found a good correlation, okay? So bear with me, we're all in Nebraska. This is $7 corn, okay? You with me? this might be the opportunity that we get for $7 apartments here. So sometimes we just gotta be happy with a winning record, right? You gotta be happy with a small profit. Sometimes, what was Ross' record? I have that wrote down in there.
1631.
16-31, you know, that was kind of like 2025. We didn't make any money, so that's a good correlation. We all kind of can relate to that, right? We're all Husker fans. So was a 470 board an opportunity in 25? If you had a 450 break even on a 220 APH and a 30 under basis, no, I didn't make any money. Didn't lose you a ton, but I didn't make any money. If you had a 230 bushel crop, which I doubt anyone in this room is fertilizing just to raise their APH or lower. You're trying to raise 10%, 20% above your APH like I am. If that happens, now that 30 under basis, your break even goes down to 430, and that 30 under basis turns into 440 cash, and that makes you money. So you gotta think about things like that when you're planning. If you can store it, you can capture the carry spreads. There was an 18-cent spread to the March, East March, and now basis is around 15 under for February delivery. Now that's 473 cash. Okay, that makes you money. If you can store corn till July, 35-cent carry spread, what's basis gonna be? I'm gonna throw in a 5 under. I don't know that yet, but I think it'll have a potential to get there. So now you're talking $5 cash corn in June. And that makes you some good money. So if you have some bin space, you can do some things to merchandise that to add a lot of value. Opportunity kind of looks like this. 477 was last year's high on the East 26 chart. And then 489 was a high a year ago on that same East 26. So we believe that anywhere between 450 and let's say $5, we probably better be layering in some pretty good sales in that range there. That's kind of what we feel is a good opportunity this year. Soybeans, same thing, opportunity lays in that 1060 range up to about 1220. We've got guys that already have some sales on the books when it hit 1130 the other day. So and we've got to start, but it's nothing real big yet. We hit those numbers again on the way up. And then you just gotta execute fearlessly. If you guys have any sort of revenue crop insurance, that needs to be used as a selling tool. You can sell up to that insurance guarantee. You gotta make sure you have the harvest price option on there. Just talk through that with your insurance agent and have a plan for that. Run the scenario that if, make your insurance guy run a scenario that, if I'm 60% sold and I have a hailstorm and corn goes to $7, what's that gonna look like? How do what's my payment gonna be? So if you're hedged and you can do that fairly comfortably. When opportunity meets your plan, you just gotta sell aggressively. If you get emotional, you just simply have to own some calls. You got some re-ownership with that. It just keeps you in your mind right with the market going higher. So we have two plans. We've got a core plan. I'll go through this pretty quick, very simple. We sell grain on rallies. We manage risk with put options. Long puts give you a price floor. It just gives you a safety net in there. So you feel pretty comfortable about waiting for an opportunity at a higher price. It's really, a lot of folks think that if you buy a put, you're bearish. No, you buy a put because you're not bullish, but you're hoping for a higher price. But you have a backup just in case you're wrong and it doesn't go higher. You're just buying time to see what the market does. So that's kind of how we look at those things. We want to own puts on unsold production. You don't need to own puts on stuff you've already got sold. And then we manage those puts up and down. If we get a market, like I showed you on the cattle, we can roll that put up to a better put. That's a good thing. Make a sale, but move those unsold bushels up to a better floor. We like to keep balanced. We'll tell you to be 100% protected between, if you're 50% sold, you only need 50% with puts. If you're 80% sold, you only need 20% with puts. So we like to keep guys 100% protected, but that's up to you. And then we manage those up and down as the market allows. We stay hedged until those sales are made. Once you make a sale that is covered with an option, you don't need that anymore. You get rid of it. You get back what you can out of it and take your money and run. So we give an alert every week, comes out on Tuesday after the markets. We tell you where our next sales target is, where our next hedge recommendation is, and some commentary about that week. And then we've got our RPM plan. This is our premier plan. We sit down with guys a couple times a year and develop a break even. Again, this is what our break even looks like. So from there, we help make realistic assumptions of where the market can go and help develop a plan of attack for the price risk, the production risk, the emotional risk, and all that we just talked about. So what's our potential? You know, we're not expecting anything real great this year. Maybe a 5% ROI. If you hit 10%, you probably better be as sold as you're comfortable selling. That's just our opinion. We execute sales that you agree with, so we make sure it gets done. So if your break even is here, we get to, you know, this 470 area, instead of calling and saying, hey, John, I think you should sell corn today. We've already got an order working either on the board of trade or with an elevator of your choice, and that is a working target. And it's hey, that target we talked about back in January when we set up these plans, that filled today. Now the next one is this, and what are we gonna do about it? So that's kind of our approach there. And then you gotta manage those emotions. So simply put, you put a put in place just in case this takes off and goes lower. So you want that put where that red line is there. You make some sales along the way at levels that make sense. Now, this is a pretty broad picture, so we've got the high of 22 in there as well. But we've got the lows of that 2013 to 2020, the 2020 crop there. So we're gonna make pretty aggressive sales in there. If this is a year where we do have an honest to God weather problem, there's nothing to say we can't go back to these levels. But it's gonna take a weather problem for that to happen. Are we banking on that? Absolutely not. So we're gonna get aggressive with sales, just in case, if you're Dr. Jekyll and Mr. Hyde, and all of a sudden, you know, corn goes another $1 higher from where we made the sale for you, and you're gonna get pretty emotional about it, because you missed a lot of opportunity. We gotta have some calls in place. You re-own the bushels you already sold, and you have the upside potential on those bushels, plus the bushels you haven't sold, and it just helps bring up your average. So that's our philosophy behind doing what we do. Fairly simple. It's a little more complex when you look at it from a day-to-day picture. And then from there, we just manage the carry spreads and basis to squeeze everything out of the market that we possibly can. Carry spreads look like this. Back in September 25, East corn was 418, March was 436, May was 447, and July was 453. I don't care about the prices, I care about the spread between them. East to March spread was 18 cents, East to May was March to May was another 11, and May to July was another 6. So we look at that and advise people on, should we, if you have bid space, you have bid space to do this, obviously. Should you hold corn till March or May or July? So we look at that. And then, so we would roll your hedge, 470 hedge to the March. We pick up that 18 cents of carry spread. Now you're 488 futures off the March. And what's basis gonna be for February? In this example, we're using 10 under, so you're 478 cash on a 470 D's futures hedge. So that feels pretty good if you get all that done. It doesn't happen all at once. When futures are good, usually carry spreads are not, and basis kind of sucks. And when it just vice versa, when futures are bad, basis starts getting better. It has to do more work to get corn moving, and so on and so forth. So we just try and add value to that bid space. It's up to you to tell us if that works in your operation or not to hold corn till July. If it doesn't, then we don't want to worry about it. We'll do whatever works for your operation. Our job is to tell you what the market's telling you to do. It's your job to tell us if that works for you or not. So, does your farm make you money? You have to have futures price. You have to have a hedge derived. You have to have a Chicago Board of Trade position to be able to capture that carry. So, and like I said, those three things do not happen all at the same time. And we're basis traders, so we look at this map and anywhere between 70 under basis up in central South Dakota to 10, actually in Ohio, I saw 30 over the other day. Why is that the case? Because we have 3.2 billion bushels worth of exports that needs to go down the river, which is over here. And that is a fantastic pull. Prices kind of stink, so basis is having to do the work to get the corn peeled out of the farmer's hands. Remember back to the yield scenario, Illinois, Indiana, Ohio they had good crops, but not fantastic crops. They weren't records. So corn's a little tighter out there. Our stocks in the west are big, it's where the crops were. That's why we have a terrible basis. In the east, they're a little bit less, and the demand pull is there. We're not taking corn to Garden City, Kansas right now, because they raised their own crop down there this year. They had a fantastic yield on the dryland. Yields that they have never seen before. So we'll chew through that eventually, and that will become a demand pull. Garden City is a demand pull, Hereford, Texas is a demand pull, Greeley, Colorado is a demand pull. Those things all will get better and our basis will tend to improve because of that. So that's just kind of what we're seeing today. So you're not giving up control on anything, it's still your plan. It's a partnership, help you make the right decision. We help fine tune those decisions to maximize profits. We're not trying to predict price or anything like that. Again, if we were doing that, we'd trade our own accounts. So kind of to close here, we do hope that the worst is behind us. Sometimes you get a bullish report, sometimes you get a bearish report. You just gotta play with the hand that you're dealt, right? Hopefully all the negative news is priced into this and we start building a base here and working our way up. If you've noticed, corn futures have stabilized and they're starting to rebound. Not saying that we're gonna go at $5 anytime soon, but that's incredibly good that we're at least stopped the bleeding and we're trying to rally some. Hitting those singles and doubles are key. We're always one weather problem away from wild and crazy though. So like I said, you gotta have a plan and you gotta plan for every scenario out there. Sometimes it's tough, but just do some thinking about it. 2026 still does look to be pretty challenging until we get supply dwindled down a little bit and better demand. We still think it's a pretty tight margin environment. So we can't screw around and assume that we're gonna go to $5. Basically, don't have your first target at 5. Probably something before that, layer into it. Don't have your own eggs in one basket type of an approach there. The feeling of the need to be right, we think would probably cloud some good decision making this year. You know, someone feels like I have to get $5 for my corn, so they wait, and then I'll sell it all when it gets to 5. Well, you know what it's gonna do? It's gonna go to $4.99.5 and go down. So that's typically what happens when you put a target in there. In 08, corn did not go to $8. It went to $7.99 3/4. Okay. So still need to know your numbers, not just the number you get from the bank. Start with your QuickBooks, go through that with a fine tooth comb, back into it. You'll get a pretty good start on 2026. So I can't stress that enough. Know your numbers, know exactly where you make money, and use that information to build your plan, your structured plan. So that's all I've got. For non-customers, you know, if you guys are, never seen us talk, you wanna know more, I went through the high points really quick. We'd love to sit down with you. I don't think there's a blue sheet in your packet, but, if I'll be around if you wanna visit. Chris couldn't make it today. He's the one who's usually in this area. So I'll get you in touch with him. He'll come sit down, look on your farm, show you what we do in a little more detail. We're not high pressure. If you wanna do it, great. If not, no big deal. But otherwise, you know, we definitely wish everybody a very successful 2026. I think there's some optimism out there. You kind of gotta dig for it a little bit to find that optimism. But I do think there's some optimism and we'll have some opportunities in 2026. So with that, I will take any questions and hopefully I can answer. Yeah.
Are you seeing more soybeans being planted in this year, so they're input costs? And are a little bit better price, and they do keep me more sense of seeing
Yeah, our soybeans being planted more this year, yes, I think there will be. Now, I was in Iowa last week and unofficial poll asked if they were planting more corn, more soybeans, and actually more acres went up for corn. It's north central Iowa, in an area where they can raise 250 bushel corn pretty easy. But they can't seem to get over 65 bushel beans. So the economics of beans versus corn are tough in that area. But as a general rule of thumb, I think we're seeing a little pullback to more beans. Nobody likes fertilizer prices. We're trying to figure out how to cut expenses as much as possible. I've got one customer over by Hastings. He's switching from all corn last year to all beans this year. He does not want to pay the high priced fertilizer. Is that the right thing to do? I'm more of a stick with your rotation type of guy, but to each their own, right? There's another question.
The raw areas you spoke of, Kansas and Colorado and in Texas, what makes them significant as far as the demand in those areas for grain?
Feedlots, feedlots, methanol. Big feedlots around Garden City, Scott City area, big feedlots in Greeley. Southwest Nebraska, that black shirt feeders in Dickelman, they got permitted to 150,000. I heard they got an extension to 200,000, and I heard the other day they extended to 250,000. So that's gonna be a monster for Southwest Nebraska here pretty quick. But yeah, just a lot of feed demand in those high plains areas.
When do you think that solely have a ripple effect for everybody outside of that area?
Oh, yeah, definitely. Yeah, basis is just a, how far out do I gotta go to get a corn supply, right? So you're gonna, around Garden City, they just don't have, they have irrigation there, but they have more mouths than they have, more demand than supply. So they chew through their supply pretty quick. They gotta go out to eastern Kansas into Nebraska. That's why the truck market here last year, there was trucks lined up in Holdridge every day, and they were all going south. I think the Garden City area. But in 22, trains were coming out of Iowa, Illinois, going that way because they had a terrible drought in 22. So just supply, demand, and basis has to do the work to get corn from farther and farther away. Yeah. So it comes into central Nebraska usually by May, June, July, we start to see the effects and corn will start getting trucked that way. Now this year with their big crop, it may take a little longer.
we've had stronger bases coming out of harvest than we maybe seen in the past. Are you guys seeing much actually selling and buying back on the board to take advantage of deeper old crop runs into next year, or what are you guys doing as far as that?
Yeah. I hate paying storage at the elevator, so if a guy wants to still have some upside potential, we have recommended since harvest that you just sell the bushels, buy back with a call or futures, whatever you want to re-own it and still have some skin in the game. We're not of the opinion that JFM basis is gonna get much better. So if it's been bushels that has to move, since I took a lot of bags in the field, if you have to move that in January, February, March, if you can get a good number, I'd sell it. And if you wanna re-own it back on paper for a potential for a summer weather rally or whatever, fine. Don't spend a ton of money, because, if we get a rally, we've got a whole lot of hedge pressure coming too. So we're not, unless we have a weather problem, we're not expecting a real big rally, so.
Yeah, and when you buy it, well, I guess I'm speaking more to actually buying it back on the board, not calls.
Yeah.
But you're giving up the option, you're not locked in the floor, obviously.
Yeah, you're just back to open on the
You're
futures.
open, but you don't worry about spoilage, you don't worry about carry costs, you lock in your basis,
Correct.
and then you've got more flexibility behind you.
Yeah.
Sell when the price is right.
Yeah.
Supposed to sell and haul when the price is right.
Yeah, exactly. Yeah, you're just back to, you're open to market risk at that point. As a farmer, you're naturally long corn, right? Long just means buy in the trading world. So you haven't bought corn, but you bought ground, planter, seed, fertilizer, chemical to raise that crop. So you're long that crop. To get back to neutral, you gotta sell it. Then you're done for that year and you're flat. You have no risk. So if you sell it, sell your physical crop and reel it back on paper, you're back to long making and you just have market risk. If you buy it today at 430 or where we're at, you sell your cash at 430 or futures at 430 minus basis. And markets go up, you're penny for penny on the way up. It's like you didn't sell it, but it's also penny for penny on the way down, just like you hadn't sold it. So you have a 430 sale, you take a 20-cent loss, you're back to 410 then. That's just the risk that you take. Where a call would limit that risk to the downside, so. Risk appetite would be what I would, the difference between the two. Yeah. So on the other hand there. Yeah,
Any thoughts on ISID in Lexington this week?
yeah, kind of a blow to the area. I talked to Adams Speeders the other day. They've got their, folks space spoken for, like Grand Island, some in Greeley. So the market will adjust accordingly. Will there be a shift of cattle out of this area because of Tyson? I don't think so. In fact, Adams is expanding up in Broken Bow. So, I don't think short term, yes, jobs, other job, the local economy, not good. It's like when Cabela's left Sydney. But if Sydney's recovering, they're finding their new norm now, we'll find that new norm and so on and so forth. So, yeah, big picture impact, I don't think it will. I hope it gets sold, but I've heard Tyson won't sell it. And the reason they got rid of it, from what I've heard, is it was a combine plant, right? It wasn't meant, they didn't build it to slaughter cattle, and so they've had to retrofit it. And, they upgraded the Amarillo facility because it was built for a slaughter facility, and they can't retrofit it, they can't upgrade it. This one, it would be really, really expensive to upgrade. That's kind of what I've heard, so, you look at something like we've got guys, with farms this year, high priced inputs, cash rent agreements, maybe that's not so favorable. Categorize what's making you money, what's not. You just gotta get rid of the ones that are losing you money, so now I don't think the Lexington plant will lose the money by any means, but that's their mentality, I think. So. Any questions? Anybody else?
Yeah, we raise good yields. You think that $4 range that you played out there could be really high compared to if we raise good yields? Could we be 350, 375?
I think that, that 385 is what I hope that stops it. Realistically, for that to be the case, we just need more time. With inflation, can we go sub 385 and go to 350? I don't think you can rule it out. If we start getting into a 18 to 20% stocks use ratio, I'll run the numbers what that would be, but we would have to de-incentivize the farmer to plant more corn in 27. So, and then how you do it is price. Yeah.
2026 ARC and TLC payments from the big beautiful bill. Where prices need to get down to for that?
I'm not 100% clear on that. They did raise the farm gate price to 410 the other day, so that's not gonna help hit that trigger, but I think the trigger, I lost what the number would be, but, I think there will be, if things stay the way they are, granted, it's the marketing year average, so we still have another, till August, the end of August this year to really see what that number is, and then we'll get a payment next October. Long time away. It looks like there'll be a payment right now. How much? I don't know. Last year's, did you guys get our payments. The hail in 24 should have helped the county average here be low enough to where you got a 24 payment in this October. I got one. Phelps County. We don't like government programs until we get them, then we like them, but. So, and that's more insurance, that's not a handout. Any others? Okay, well, we're good. I'll be around for a little bit, so. Thank you. Thank you, very much. Thank you, Flatwater.
All right, I appreciate it, Justin. Thanks a lot. Yeah, appreciate everyone coming today and taking time out. Wind's not blowing in here. I think it probably still is out there today, so. Appreciate Justin and AgWest for coming in and sharing their insights. One other thing I wanted to bring up while you guys are here, I want to introduce you to another partner that we've developed, an outfit called Mac America. We have another Justin in our audience out here. Mac America is a company that helps place ag real estate funds, like a better term. And so right now, everybody knows that ag real estate market is pretty hot based on a couple of recent sales here in the area. And getting a partner in place to help facilitate that is important in our area here. So want to introduce Justin and kind of just have him go over what his outfit does and how they could possibly help partner with Flatwater, our customers, to get some long-term rate, fixed rate financing put in place, so.
Perfect. Thank you, Brett.
Yep.
First of all, I want to thank Flatwater Bank, Luke, Brett, and Ryan for having me here today. We work with banks all across the country. Company's called Mac America Ag Finance. We're actually based out of David City, Nebraska, so we're local. We have independent loan advisors from Ohio to Montana, kind of everywhere in between. So we can do business in all 50 states. Basically what we do, we work with banks who are trying to help their customer with long-term ag real estate finance. So the things that the banks, they have great tools for more short-term stuff. We have those tools for the long-term stuff. And ultimately, Flatwater's always trying to put themselves in the best position possible, put their customers in the best position possible to do what's best for them. And we appreciate banks that are doing that, but we offer up to 30-year fully fixed rates. Our rates are going to be extremely competitive with about anybody out there. Typically, our rates are going to be right on par with Farm Credit with their dividend. The difference between us and Farm Credit is we do not have a 1-year lockout. So there's not a period of time after you finance that loan that you're locked out of refinancing it. We don't have that. We don't have a dividend. It's in the rate. So there is no waiting to find out if you get the dividend or anything like that. We only take the real estate that we need to get you the best rate possible. So, typically, 50 to 60% loan to value in almost all instances is going to get you the best rate possible. If you have a lot of additional land that we don't need to collateralize, we leave it free and clear. That puts the bank in the best position possible, that they can get you the best rates possible. It also frees you up for whatever comes down the road. Okay. It's very atypical in the industry. I was a banker for well over a decade. My business partner, Steve McGuire, we started this company about 9 years ago. He's a banker for over a quarter century. We know how banks work. We know kind of what they're looking at and what they're looking for. And we want to help banks put themselves in the best position possible to help you guys, thrive. So kind of our philosophy is we look to put you in the best position possible when times are good, average, and I know it seems like things are kind of tough right now, but we're not in bad times. It can get a lot worse. It can extend out and it can get deeper. We want to put you in the best position possible when times are good, so that when times do get tough and we do get those tough times, that you guys are survivors. And we want to put you in the best position possible, that if you're already
in a good position. You've already got things well in hand that we can help you be one of those people that really thrive when times get, when we have depressed crop prices, when we have depressed land prices, those things, you're already in the position to make that next step. So that's kind of our philosophy, and we've partnered with Flatwater Bank as well as several other banks who are interested in putting their customers in the best position possible to do that. We do not have prepayment penalties and we do not have origination fees. So if rates go up, and like I said, typically we use 30-year fixed rates. We do offer, 3, 5, 10-year, 15-year resets. For the majority of the beginning of our company, pretty much everything we did was 30-year fixed rates. The yield curve was fairly flat. There wasn't a ton of difference, and the opportunity cost of doing something shorter term wasn't worth it. Right now, that yield curve is fairly steep. So there's a significant difference between, say, a 3 or a 5-year reset on 30 years and a 30-year fixed. So we might recommend something shorter term, or we might recommend something that is more, more blended in terms of, we might do part of it as a 15 or a 30-year number, and we might do something more short term. As a general rule, though, we do pretty much everything over 30 years. We can do shorter if we need to, but 30-year term of the loan, whether we fix the rate out or not, is pretty typical. What that's going to do for you guys is that's going to put you in the best position possible, that you're going to maximize, you're going to have the lowest payment and the most flexibility. Because remember, we don't have a prepayment penalty. Once you get to the end of the year and you find out we had a great crop, or we had a great, you got extra money, whatever, pay it down on that loan. But we want to keep that payment as low as possible, so you have flexibility if those times aren't right, that you can adjust. So again, we don't have prepayment penalties, we don't have origination fees. The other thing that's very unique about what we do versus, I think, pretty much anybody else out there, is we actively watch those rates, and we'll reach out to you when it's basically our philosophy is when rates are down about 0.5%, we're going to reach out to you and at least have that conversation. Now, it doesn't mean that every time rates are down 0.5%, we're going to refinance it. It doesn't mean that it's necessarily makes sense at that time to do it, but we don't feel that it should be your responsibility to track the markets at all times, keep track of the rates and what they're doing, what's expected, or to find out about it at the coffee shop that, hey, I got a great rate, I'm going to go call my bank and ask them to get my rate down for me, or whatever that is. We are very proactive in doing that for you. So we're going to keep you ideally in the best position possible to, no, we don't have a crystal ball. We don't always hit every top and bottom, but we're going to be working with you to try to keep those as low as possible. Obviously, if credit deteriorates or something like that, we may not be able to refinance, but we are going to work with you to try to keep those as low as possible. So in a nutshell, that's what we do. Like I said, I'm very happy that Flatwater Bank is one of the banks across the country, one of a handful of banks in Nebraska that have clearly put their, not necessarily their money, but, put their money where their mouth is to say, we're doing what's best for the farmers. A lot of banks, they're going to try to, necessarily do what's best for them first and then the farmers. We like to work with banks that are truly looking to do what's best for the farmer, put them in the best position possible, and maximize what they can do. So your bank, I'm sure, will be talking to you about it. If you have any questions about it, reach out to your bank, reach out to your personal banker. They can kind of get those processes started for you. And certainly if we can help you, I'd love to meet y'all. If anybody has any questions, I guess at this point, I'll just open it up to questions and